This is Trepp Wire Week in Review for week ending October 23rd. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. Joining me are Manus Clancy, Senior Managing Director, Joe McBride, Head of CRE Finance, and Andrew Jacobs, Head of Structured Finance. This week, with the release of some encouraging economic data points, namely a surge in retail sales last month, a new high in home builder confidence, a surprising drop in initial jobless claims, and a rise in the Consumer Sentiment Index, there are still factors pressing on the markets. Q3 corporate earnings reports highlight which sectors are underperforming, the uncertainties surrounding the upcoming presidential election, and a second wave of the virus that is sweeping through Europe, triggering new lockdowns. Manus, we've said that this recovery is fragile and uneven, where the winners of this are carrying other industry sectors.
Well, before I get into that, I want to take a very early detour in the podcast. We are recording this on Thursday, October 22nd or 23rd, 22nd, I guess. And tonight is the final debate between President Trump and Vice President Joe Biden. And I have to say, I have never been so happy to be able to watch two hapless one-win teams battle it out in football tonight, with the Giants and Eagles playing tonight. Even though it'll be miserable football, I am thrilled that I have something else to watch to take me away from the madness. So that is my short detour. Going back to the economy, it's interesting. Some of the data we saw over the last week or so has been encouraging. The retail sales, as you said. Residential housing remains on fire. Interest rates have ticked up a little bit, but not alarmingly so yet. So people can still refinance with mortgage rates in the twos. We saw a decline, as Martha mentioned, in the jobless claims, all encouraging signs. What I fear right now is that sometimes, however, investors get fixated on one part of the market to the detriment of everything else. And right now that fixation is on the stimulus 2. Over the last 10 years, we've seen fixations on, is the Fed increasing rates too fast? Is the Fed cutting rates too slow? We focus on the jobless numbers at other times, or oil prices. Right now, it's all about the stimulus. And my fear is that something will finally get pushed over the line, which from a human point of view will be terrific for those that are having trouble putting food on the table or paying their rent. But it will do nothing to get people to spend at the levels that they were spending pre-COVID. You know, you can give Andrew Jacobs $1 million and he's still not going to an Applebee's next week, you know, until there's a vaccine or a therapeutic. So
I would. You give me $1 million, I'll go to an Applebee's. I'll go to TGI Fridays. I'll go to a Sizzler if you could find one.
This is a dare. So, you know, you could flush all this money through the system, but what we saw with, you know, the Bank of America analysis early in the COVID process is that for those that still had jobs, this money didn't go to discretionary spending. It went to people's checking accounts. And my fear is that we could pass something big, which gives everybody a sugar rush and pushes hard assets higher and the stock market higher for a period of time, but it doesn't really do anything for the fundamentals. And until we get a therapeutic or a vaccine, or people start coming to terms with accepting the risk of doing more things, especially for those under 50, that this will be a false start for the economy. And that's my big concern right now.
Well, I think we're a little bit in a bubble up here, no pun intended, in New York. I think elsewhere across the country, a lot of people have come to terms with the idea of going out and putting masks on and going to restaurants and sitting outside and all that type of stuff. We're never going to get back to the, you know, restaurant and hotel spending and movie theaters and those types of things until we have the vaccine. But I think that, you know, we may be a little bit biased just because of what we see on a day-to-day basis. Now, Martha pointed out in her notes an interesting data point, which I wonder, given that the debate is tonight, I just set my DVR for it Hopefully there's room in there among all the, cooking shows and the holiday Christmas Hallmark movies and things like that, that more than 45 million Americans have already voted, 32 million in mail-in ballots, 12 million in person. And it says that 51% so far are Democrats and 26% are Republicans and 22% no party affiliation. I wonder if there's one person in that group who's already voted that will watch the debate tonight and think, shucks, I wish I could get that ballot back. I doubt it, but that would be interesting.
I think we could have had this election a year ago and nobody would have changed their mind. So I don't think the debate, absent one candidate or the other walking across the stage and tasing the other
or keeling over.
Keeling
Don't
over.
give any ideas, please.
I think that this thing is baked. But for the record, I did vote this week. Longtime listeners will know that I spent a lot of my time in New York, but most of my time in South Carolina in what's called the upstate, which is really the western part of the state. And my tip of the week is to definitely vote early, because I got there on a Tuesday afternoon at 3:30, and I thought this will be cake. I'll be in and out and in no time. Instead, with about 60 people online, it took me 45 minutes to get to the front of the line. It seems like the COVID protocols and the plexiglass and the social distancing and so forth is really taking its toll. So if you were planning on waiting till election day, you might be struck out.
I mean, I voted as well, and I've never seen so many people taking selfies with a metal box before. I think that it was only like 3 people in line, but it still took an hour.
It was really something. I got to the front of the line and they handed me a 9-inch Q-tip, and I didn't know what that was for. My first reaction is, man, you grow them down here with unusually large ear canals. But then I thought, they're going to make me take a test before I vote, aren't they? They're going to stick this up my nose. And what it was for, sadly, I started cleaning my ears a little bit, but it was to use on the electronic device so that you could, tick off who you were voting for without using your fingers, that you were to use the swab. And so there's all these little machinations going on that are really putting some sand in the gears. And, if you're waiting till 7:30 at night on the evening of election day and your polling place closes at 8, I think that's a little rash.
Well, what's the normal number of people that actually vote in the general election? I think it's like maybe 90 million or 100 million. Like, I don't think it's that. Like, so that's almost 50% have already voted.
Well, in the last election, it was 137 million for the record. And some people are saying we could get 150 million this time. And last time in total, I think we had 46 million vote early. And now we have 46 million already with another 12 days to go.
Just think about it. If you could vote via TikTok, we could get that number up to like 220 million.
It's interesting in South Carolina, as you might expect, it should go even faster because while the presidential election is being contested and the senatorship, everything else is uncontested. There's just one person for each thing, and it is deep
Town
and
supervisor.
dark red.
Town supervisor, county clerk, right?
Freeholder, Freemason. Okay.
Moving on.
We have almost the close of the month with preliminary delinquency numbers. What did the latest round of data show us?
It was quite interesting. We're not quite 100% there yet, but we're north of 90%. As we've been noting, we hit close to an all-time peak in June. We got to 10.32% delinquent in June, which was only a couple of basis points short of the all-time record. We have been declining ever since in pretty good chunks. And at the end of September, we were at 8.92%. What we're looking at right now is perhaps another decline of 60 basis points, which would take us to about 8.3%, give or take. That number could move up, 10 or 12 basis points or down 10 or 12 basis points, depending on what we see out of the last 10% to report. But it just goes to show that these forbearances that have been put through and continue to grow are making an impact. As we noted in early October, there were 30 billion in forbearances granted, of which about 2/3 were hotel loans. That represented about 5.5% of the market. I would expect that number to have grown during October. Maybe we're at 35 or 40 billion at this point. So the number continues to grow. And what that does is deflate the number of delinquent loans. So when we look at property type, just a couple more data points. The hotel delinquency rate looks like it's going down from 23% down to maybe 19 or 20%. So a big dip there, helped by the forbearance number. Retail had been about 15%. Looks like it's dropping to 14%. At the same time, we did see some modest downticks, 50 or 60 basis points in the percent of special serviced loans in those categories for lodging and retail. Lodging is still north of 25%, retail still close to 18%, but there was some decline in those areas that probably comes from loans that were returned from the master servicer, from the special servicer to the master servicer. If there's areas of concern, it would be this, that the percentage of loans that are in grace period in October ticked up about 50 basis points in the lodging space and about 20 basis points in retail. So that's sometimes a foretelling of problems that are forthcoming, but we'll see. But in general, it's of a piece with the other economic data that we've seen, first-time jobless claims, retail sales, housing, and so forth, that show a solid but not overwhelming improvement in the numbers, but something to grasp at and feel good about.
So there was one data point that may be worth pointing out for anybody who's looking at watch list numbers. There was a huge industrial loan put on the watch list this month. It was the Blackstone portfolio. So if you do see watch list percentages really increase on the industrial side, it's really due to one large loan, and it doesn't seem, based on the comments, it doesn't seem like it's too big of an issue. Just kind of looks like an administrative watch list transfer.
So let's talk about that for a minute. We'll do a quick educational segment. There are about 40 or 50 reasons why a loan can go on watch list. Some are very, very benign. Some are very serious. A benign may be that there's been a property inspection, there's a crack on the sidewalk going up to a multifamily housing property, or there's
no fire extinguishers.
No fire
in the
extinguishers. There's some mold in the lobby or something like that. They run the gamut of benign to annoying, but nobody would say that that represents a credit risk. Then they move into other categories, which are things like the loan matures in 3 months, and we're putting it on watch list just to make sure that we're on top of this as it approaches its maturity date. It doesn't mean that the loan is facing maturity default. It's just a heads up. Less benign would be things like we have a tenant with 50% of the space coming due in the next 12 months that we're watching, right? That may be a bigger area of concern. And then you have the really big ones, which are the borrower has trouble making its payments every month and is looking for COVID relief. So with these watch list notes, on a broad basis, they are indicative of growing concerns in certain parts of the market, but they're only the final story to the extent that somebody scratches beneath the surface and looks at the watch list code or the commentary that the servicer provides with it.
And once again, we had 2 trading alerts this week about valuations being cut. So this continues to be a concern.
Yeah, it's they are of the same categories that we've been talking about repeatedly over the last 3 months. The first is Houston, and the second is shopping malls. The Houston story really runs the gamut of borrowers giving back the keys to hotels, defaulting on loans in high numbers, but also office properties losing tenants, not being able to refill those tenant spaces, and watching the loans go into default, and ultimately the value of the collateral being cut. So the first story is in regard to 2 Westlake Park. It's a 450,000 square foot complex in Houston. It had ConocoPhillips as the top tenant with almost 50% of the space. ConocoPhillips vacated. The loan eventually went into default, and later the property became REO. It had been valued at $124 million back in 2014. It backed an $88.1 million loan, which is now an REO asset. It's no longer a loan. The value of that property was cut this month to just $22.1 million, which is just, I'm sorry, $24 million, which is a $100 million reduction in the value of the property. And that property is now, $66 million underwater, and it backs a deal that is in CMBX 8. So that asset's $88 million balance, which is $66 million underwater, represents 8% of the collateral behind a 2014 deal. So now that deal is looking at, 6% of its credit enhancement being washed away at some point in the near future.
So Manus, we put out this story and others obviously lately, and I forget if it was about this particular one, but there was a question from a listener about when things like this happen, when is it expected for that, eventual loss to be actually realized? And I think the question was kind of timing between foreclosure sale or foreclosure process, special servicer taking over the property, and then what?
It really varies.
Yeah.
In the last cycle, we saw properties being held onto by the special servicer for years.
Right.
Sometimes it was bringing in a new manager, hoping to re-tenant the property, waiting for liquidity to come back into the market, hoping that bids would firm up. And that kind of made sense during 2009 and 10, where people were looking to buy assets for 10 and 20 cents on the dollar, and the special servicer holding out, hoping that the market would rebound to something to say maybe 60 cents on the dollar. And that may happen here too. But what we're already seeing in this market is
there's a bid, right? There seems to be
there is
a
a bid for sure. There's a lot of cash out there floating around. So there's definitely that out there. But we're seeing quick moves, and we'll talk about this more later, by borrowers to give up properties very quickly, which would hasten the process. We've already seen 10X list a lot of these assets already, and we expect a wave of them next month and December and January. And we're seeing the special servicers move to put notes and properties up for sale very, very quickly. So that may be a function of them thinking that there is a bid out there and strike while their capital is flush. That might make a lot of sense, but we think that this resolution process will be much more compressed than that for the great financial crisis.
It could also be the fact that the last time around, it took 3 or 4 years to get to the peak of, special servicing, delinquencies, et cetera. So these guys might be looking at this and thinking, we got another couple hundred loans coming down the pipe that we have to deal with. So let's kind of plow through these and try and get them on the market. Obviously, that's a simplified version of it, but.
And let's not forget that the crisis last time, we didn't see an evaporation of demand where hotels went from 75% occupancy to 15, right? We saw offices lose tenants and slowly but surely grind lower, or multifamily properties or retail properties. Now what we're seeing is the problems go from 0 to 60 in 2 weeks.
And maybe the resolution goes from 0 to 60 in 6 months, right? That makes a lot of sense, right? Last time around, if a loan was in default, it was because the underlying property or the borrower was really in trouble. Whereas this time, if the loan is in default, it might be a great hotel and a great borrower, but there's just literally nobody coming to the hotel. But that may actually rebound pretty quickly, 6 months or a year from now.
I could see if we give Andrew that $1 million, he's not going to Applebee's for the bloomin' onion. He's looking for one of those roadside hotels with, 66 keys and, like a red roof that could be part of the family nest egg. What do you think, Andrew?
That is the question. I mean, are you going to invest in commercial real estate, or are you going to put it somewhere else? $1 million that buys a pretty nice boat. I might just go out there and relax.
That's a terrible investment, Andrew.
Find a friend with a boat. Don't get the boat. So the other story we had was about the town center at Cobb, which backs a $179 million loan. The collateral is about 560,000 square feet of retail space in Kennesaw, Georgia. Top tenants include J.C. Penney and Belk. The loan is split across 2 CMBS deals. Both are part of CMBX 6, which we've noted for quite a while is ground zero for the Big Short 2. The collateral value of that asset was cut to $116.8 million this month. The value of the collateral in 2012 was $322 million. So basically, we've seen the value cut by about 2/3 during that time. And what we're looking at now is this loan is now underwater and is a bond loss waiting to happen. So those were our 2 big stories this week in Trepp.
Loyal listeners may recall that a couple of weeks ago we discussed preparing a list of loans where the borrower is indicating an interest in returning the collateral to the lender, and Manus has done his homework.
Yes, this is an early shout out for AS, who pinged me with 2 things this week. One was a reminder that we owed our listeners this information, which I had definitely shirked and forgot. But he also called me out for referring to the Tampa Bay baseball team as the Devil Rays, which they haven't been for 13 years. They are just the Rays.
How dare you?
I knew that, man, too. And here I am using the Devil Rays as a name. So shame on me for that. But we did put out a piece today, Thursday, a blog about this. We went through special servicing notes for the last 3 or 4 months to come up with a list of loans for which the borrower has indicated a deed in lieu is likely. A deed in lieu, another educational segment, means that rather than defaulting on the loan and making the special servicer go through the administrative process or foreclosing legally, setting up legal proceedings, contesting the foreclosure, they make it really easy on the special servicer, and they go through a consensual foreclosure or a stipulated foreclosure or a deed in lieu, where they basically say, send us the paperwork, we'll sign it, we'll mail back the keys, and we'll be done. And this can hasten the process from a several-year process to maybe a couple of months. And we've seen some of the big mall REITs do this. We've seen a lot of hoteliers do this. And when we went through the commentary, what we found was almost 100 loans totaling about $4 billion in loan balance, for which the borrower has indicated they're willing to transition the asset back to the lender. And that's an extraordinary number. It's an extraordinary pace, and it doesn't even take into consideration another 25 to 50 loans for which are already REO, because the process happens so fast that the keys have already been mailed back. So if we had looked at stuff through the entire cycle, we might be talking about $6 or $7 billion worth of debt at this point. This is a very fluid situation. Borrowers can change their minds. In some cases, it means transitioning the properties not to the special servicer, but to a mezz lender. And the word from the special servicer that this is likely to happen is not the final word. Things can reverse course, but it is an indication. And 2 big areas that just lit up the spreadsheet that we had were shopping malls, which represented probably 10 of the top 15 hotels in the Houston MSA, which were a dominant part of the hotel space, and then big portfolio loans from lenders that are just over-levered. So this was something that we wrote up. If you didn't get our blog, ping us. We'll send it to you. And it's just a really interesting piece of data.
Just to give you some context on those numbers, Manus, it's about 4.08 billion. 2 billion of it is retail. 1.9 billion of it is lodging. So it's essentially all retail and lodging. There's a couple of loans, office, mixed use, maybe one multifamily, but those are kind of negligible compared to the rest. For those of you who are still interested in that old Big Short or the new Big Short story, there are 9 loans that are in CMBX 6, about 425 million for the 24. 16 loans in CMBX 7, 823 million, and then about 9 loans in CMBX 8. So I'm sure there's some analysts feverishly looking over this list right now as we speak, redoing some of their assumptions on whether they're short or long.
So just as a shameless plug, this is data that on a granular level, we do give to our clients. We don't give it to people on the podcast, but we do make the summary value of this available through our blog. So we want to make sure that that's clear.
There were a couple interesting stories on hotels. Marriott and some other hotel chains are looking at launching a subscription service to attract some revenue, kind of an all-you-can-travel model. How is that going to work when so few people are traveling right now?
To me, it sounds like something that is being repurposed, that has been around for a long time and had a different kind of sullied name. And they're trying to repackage this as something brand new and not quite so shady. And it was called a timeshare, where you'd pay somebody $10,000 and big management fees. And now if you listen to the radio, you can't go through an hour of AM radio without hearing an ad from some guy who claims he can get you out of your timeshare. So this is something I'm not just walking from, I'm running from.
So every company in the world right now is envious of the monthly and annual recurring revenue of software as a service businesses. So I think we talked about this. Wasn't there some coffee company that was doing this, where you could pay in advance a monthly subscription?
Prêt à manger.
Right? It was prêt à manger, yeah. Right? Now, it makes sense in some ways, because if you're the ultimate traveler, maybe you look at this as a buy low situation. Like, I know a lot of people who are planning trips 6 months out and saying, hey, given the fact that everyone's letting us cancel and waive our fees, we might as well plan a trip and get something at 40 cents on the dollar. So maybe if you're planning on doing your road trip across America, Manus, we can just call up Motel 6 and get a subscription package. I will say, I was once lured into a timeshare sales pitch, and I didn't realize what was happening until about halfway through. It's kind of like when someone pitched me a pyramid scheme. It's like halfway through, you're like, oh, okay, I got to get out of here. But I will say that the salespeople that sell timeshares are some of the most impressive salespeople that I've ever met. They throw so many numbers and charts and graphs and grids. They write stuff on pieces of paper. They get to the point where you're almost trying to remind yourself, hey, I'm not supposed to do this, but somehow they're hypnotizing you into buying the timeshare. We were about 5 minutes from signing some paper and walking out of the room and not knowing what the heck happened.
This sounds like, if there's anybody out there that traffics in the Nigerian Prince email, Joe might be someone you might want to add to your target list.
I'll be getting a lot of spam. I think they do the math where they're like, well, how many days of vacation do you get a year? Oh, 2 weeks. Oh, well, that's like $300 a day that you would be spending if you're staying at a hotel. You should spend it with us. It's and they don't let you leave the room. It's kind of like being in a car dealership. Like, they don't let you leave.
I'm one of those guys, I have to admit, I'm a sucker for the TV ad, that everything works. Like, I want to make julienne, French fries by just like squeezing a potato through a thing. I want that thing that massages your scalp and makes your hair grow even thicker. I want Balance of Nature vitamins because I think that they're going to make me live healthier. So there's a part of me
that thing that turns the hamburger, it puts the cheese in the middle of the hamburger so that when you cook it, it comes out like molten hot lava.
I want that pot that, in the unlikely chance that I explode a pen on my fry pan, it's going to come off, very easily. I'm just gonna have to run some water off and that whole stain will go away. Like, so I kind of get your whole timeshare thing. Like, I'm a sucker for the, those types of come-ons.
I'm a sucker for a good salesperson. Like, even though I know that they're trying to sell me, like if they do a good job trying to sell me, then I feel like I almost owe it to them. Like, yeah, all right, I'll buy something from you just because you did a good job, not because I actually want the thing.
Andrew, you must have a story about this that, you walk down the thing or you watch something on TV and next thing you know, you got these
Furbies.
car mats for your Jeep Cherokee that cost you $400 or something. You think, God, what was I thinking about? Like, I'm not a stupid guy, but that was just dumb.
Fortunately, I have tremendous self-control, so I have no such stories. But I will point out, though, that I think part of it is that they're not just kind of selling hotel rooms for sleeping there. They're selling hotel rooms to work or to have a place to hang out away from home or whatever it is. Use the amenities of the hotel. And I personally wouldn't take advantage of it, but I suppose there's people out there. I mean, our colleague who listens to the podcast, I can imagine him taking advantage of this subscription.
It's Steel City Dave. That's Steel City Dave.
But and then from the it's a clear win for the hotels. I mean, if they're losing all this value on their real estate, they got to make it up somewhere else. And this reduces their exposure to individual properties too.
Well, we talked to a couple of a professor and then an MBA student from UNC. We're going to be releasing that, I think, in a week or two. But they had mentioned that there's a bunch of hotels around the campus that are doing great business, right? Because they're being used either as quarantine zones or they're being used by parents who are visiting or professors who don't want to stay, in their kind of college. Not dorms, but basically their college residences, things like that.
I'm telling you, they're trying to stay away from the long arm of the RA, right? They're saying, we want to have a party with 6 people tonight. And, if we try to do that in the dorm, that RA is going to have our scalp.
Who's worse, the RA or the security guard at the hotel? Got to be the RA.
Got to be the RA.
Security guard you can invite to the party. The RA is just some sophomore on a power trip. I might be biased. I got in a little trouble from RAs in my day.
Yeah, I'm sure you did. Let's look at shout outs of the week. We have a few this week. And the first is Jan Freitag. And by the way, Jan, we've probably mispronounced your name in previous podcasts. We apologize. Who loves to hear us talk about hotels. He reached out in an answer to Manus's Counting Car Index, if you listened to that last week. And he gave us a better metric. TomTom data provides traffic data by country, and it's pretty impressive. So we're going to take a look at that.
Well, to give Jan a little nugget, because he loves when we talk about hotels, there was a very interesting or weird article in the Wall Street Journal this week about a New York City hotel investor who purchased a Beverly Hills hotel that was actually, I don't want to say repossessed, or basically taken by the U.S. government after seizing it from a fugitive Malaysian financier.
J-Lo.
So go take a look at that. Yeah,
the
J-Lo.
financier's name is J-Lo.
That's right. That's right.
I'll give a shout out. I wanted to shout out to James Eng at Old Capital. He's a listener, and he invited me to their annual multifamily conference, which I think they had 700 people attend virtually. He and Paul Peoples, Michael Becker, put together a great conference, and I was able to connect with several people through LinkedIn and learn a lot from the lending side and from the broker side about that. So grateful for the invite there, and happy to learn a lot from that annual event, which they did a great job at.
And a few more, Beth Z from Arizona, who was interested in the taller data report and the information about a bank presentation that Manus had done. Our own G'day from New Jersey is a loyal listener, so thank you for that. And Danny C from Watermill, a religious listener of the podcast, and he reaches out to our producer regularly. So thank you, Danny. And now, deal of the week.
Deal of the week. Podcast at Trepp.com.
The deal of the week came to us from Commercial Observer, which we read religiously. We think that's a great publication. SL Green sold a $100 million B note on a Long Island City office. The price of that B note was 95 cents on the dollar, which just goes to show that people are not shying away from buying good assets at fair prices. I think that's a very nice sign, especially in a market like New York, which has had its challenges. The property was 1 Court Square in Long Island City. It was the subject of a lot of news over the last 2 or 3 years that we wrote about many times in Trepp Wire. It became a problem for investors at one point when Citi decided it would be vacating the property. I shouldn't say it was a problem, it was a concern. They had hundreds of thousands of square feet in that Queens, New York property.
This was the potential Amazon property too.
Right. The solution was Amazon came in for HQ2, which made everybody feel good about that big CMBS loan. It became a problem again when Amazon pulled the plug on that idea. And it became a positive story again when Centene, the healthcare firm, came in and took a big portion of the space in that property, allowing the loan to be paid off in full. So that CMBS loan that was out there and was of concern at one time has now been paid off. But as for the B note, Adam Spies and Doug Harmon and Steve Cohn of Cushman repped the note seller, which was SL Green, and Davidson Kepner was the buyer. So that was our deal of the week.
Andrew, you have said that corporate CLOs have gone through a full credit cycle in just 6 months. Take us through a little bit of what that looks like.
Sure. So the National Bureau of Economic Research reports that there have been 11 credit cycles since World War II, with an average length of 69 months. And I'm going to make the only mildly facetious argument that CLOs have gone through a credit cycle in the past 6 months. So if you go back to February pre-COVID, CLOs are going gangbusters, and they've been going gangbusters for years. So February was no different. Tons and tons of refis, tons of issuance volume. And then in March, of course, COVID hit and everything stopped. One thing I will note, though, is that in March, as sellers were kind of flocking to the secondary market and trying to, unload their exposures, trade rate hit 71%. So trade rate is just a measure of what percentage of bonds actually trade after being put up for sale. 71%, in my experience, is fairly high, and it just shows that even though people were, trying to get out, there were similarly a bunch of people trying to get in and take advantage of the dip. Nonetheless, in April, there was, still a fair amount of volatility, but only 3 weeks after the market shut down in March, issuance resumed in the corporate CLO space. So one of the biggest managers in the entire space issued a brand new deal, and so still sort of downturn, but kind of turning around into that repair phase. We saw issuance resume. Now, the quality of the issuance, or the quality of the deal, was a little bit different than the deals that were coming out in February. Namely, they were just a lot shorter in terms of the weighted average life, how long the deal was expected to last, which was is a typical thing when things get volatile. Corporate CLOs are managed deals. They're dynamic. The CLO manager can buy and sell loans basically at will. When things are kind of a little shaky, investors like to see a little bit less flexibility to the manager. And then additionally, some of the very first deals that were issued in April were actually static deals. So it's, CMBS and most other structured finance asset classes are just static. The pool is what it is at the beginning, and it just runs down. And that's how these deals were issued in April. Going into May, though, it wasn't all roses. It wasn't a clear trajectory up. There was volatility in May. There were fundamental issues. A lot of triggers in the deals were being tripped because of downgrades to the corporate loans. And when corporate loans get downgraded, a lot of times money has to be diverted away from the junior investors and back up to the senior investors. So one of the biggest and most prestigious CLO managers actually had decided to defer their management fees in May, or at least part of their management fees in May, so that their junior investors could continue getting paid even though things were not looking so good. But as the year continued, we were in June, and the market basically returned to normal. Another of top manager priced a new issue CLO of $500 million, which is pretty much an average size deal. It returned to a dynamic deal, so it no longer static. And it was still a little shorter than usual, but the deals were structured to be a little bit longer than they were back in April when things resumed. So from March, where we were in a clear downturn in the CLO market, we were already in a recovery phase by June. And then closing the circle, in July, we actually got to some signs of an expansion where now that issuance had resumed and was full throttle, CLO managers started pushing rating agencies to allow them to loosen some of the credit standards in the CLOs. Specifically, they were asking for CCC buckets to be larger so that they had more opportunity to take advantage of the loans that had been downgraded in the market. And since then, there's been tons and tons of issuance. So it does feel almost like over the course of 6 months, the CLO market went through a cycle. Obviously, there's macro concerns now and still lots of fundamental issues, but it's been quite the roller coaster.
Now, this compares very favorably and similarly to the great financial crisis, right? The CLO market was incredibly resilient back then, wasn't it?
It was in terms of performance, but the issuance market, the new issuance market back then was paused for quite a bit longer. It was basically in 2008 all the way through 2012, 2013. You saw basically no corporate CLO issuance. Obviously, the current crisis is quite a bit different, but 3 weeks versus years and years and years of no issuance. But you are correct in terms of performance. The corporate CLOs back then, dealt with the GFR quite well, and not only that, the performance of deals issued in 2007, right before the crisis, were some of the best performing deals of all time because they were able to take advantage of the volatility.
So, Andrew, given the structural side of CLOs and how they are kind of pretty well designed to protect bondholders, at least the AAA bondholders, you talked about those tests, right? Interest coverage, over collateralization, and other diversions that happen when those tests are failed. Like, what would it take for there to be serious trouble to those bondholders? Like, is it, I mean, I'm sure it's possible, but like, what's a reasonable scenario where you would actually see some serious issues there?
Yeah, so I mean, there are a lot of tests and a lot of triggers in the deal, which essentially, as soon as things start getting a little shaky, the deal starts to deleverage. And if you look at the structure of a corporate CLO, on average, a AAA will have about 36, 37% subordination. But that's just plain old subordination. Effective subordination is higher because, like I said, there's a lot of diversion of cash when things get bad. If you think about the history of corporate loans and the recovery rates, long-term recovery rates for corporate loans are close to 80%. Recently, there's been a decline in credit standards in the underlying corporate loans, and people are expecting lower recoveries, when and if there's another corporate credit cycle. So maybe 70 or 60% or something like that, depending on who you're reading. But even if you assume 60% or even 50%, if you assume the entire pool defaults, you're still covered at the AAA level. So you have to really imagine a massive market event where there's tons and tons of defaults over a long period of time, or you have to imagine that recovery rates on corporate loans go way, way lower than we've ever seen before.
Don't jinx it, Andrew.
Retailers are gearing up for a post-pandemic holiday season. We talked about the catalog last week that Amazon is launching for holiday shopping. Well, Target isn't sitting on its laurels. They're launching a month of Black Friday deals, and they plan to double the number of parking spots for pickup.
They're going to double the number of parking spots for pickup. That's kind of funny. They could triple it. They could quadruple it or quintuple it. There's plenty of room in those parking lots, I think, right now. So I was thinking about the toys as a service model. Just like we're selling subscriptions to coffee and to hotels, we should sell subscriptions to toys. I'm sure it exists out there. That's something, 7-year-old Joe would have absolutely been all over. But yeah, I think that Black Friday doesn't really mean anything anymore, because it's not really a thing. It's Prime Day all month. It's Black Friday all of November. So it's all getting watered down. I miss the days where I would show up to the Target at 3 a.m. and get in line and then just get my elbow pads on and ready to just make a full sprint to that 75-inch TV that they were selling for $22, kind of like Monica and Phoebe in the wedding dress store. You know what I mean? How about
Didn't you
that
get pinched
for a
Didn't you get pinched one time running over a 75-year-old woman?
She was in the way. Deals are deals, man.
Well, with that, we'll close. Thanks to our producer, Keegan St. Ange. May join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the Tripwire podcast with your favorite provider. Thank you for listening and stay well.
All right.